Welcome to ESG 101, Practical Approaches for Navigating Compliance, Controls, and Sustainability Reporting, brought to you by the Controllers Council. My name is Neil Brown, Executive Director of the Controllers Council, and before I introduce our expert panelist and our partner sponsor, let me share some brief housekeeping items. We will have Q&A at the end of the presentation, so please use your GoToWebinar control panel to ask any questions, and as time permits, we will answer. And if time does not permit, we can follow up via email post-webcast. Next, you'll receive a link to this webcast via email in the next 24 hours, so no need for notes or screenshots. With that, I'd like to introduce our partner and sponsor, Visual Lease, the #1 lease optimization solution provider trusted by over 1,500 organizations worldwide to ensure compliance with lease accounting standards, meet ESG reporting needs, and leverage lease portfolios for strategic, financial, and operational outcomes. For more information, visit visuallease.com. Next, I'm very pleased to introduce our expert panelist, Katie Meeker, a seasoned marketing professional with over 13 years of experience in B2B and software as a service industries. Katie joined Visual Lease in January of this year as Director of Product Marketing and Creative Services. Having led the product launch for VL's ESG Steward, she's acutely aware of the pressures the Office of Finance is facing when it comes to preparation and execution of environmental reporting. Welcome, Katie.
So much, Neil. Appreciate you having us here today.
Excellent.
Great. So let's jump into it. Here's the plan for today. First, we're going to get grounded in ESG as a practice and make sure we're all using the same language to understand what it is, what we're measuring, and who's involved. Then we'll talk a bit about the guidance and standards out there that are dictating what we measure and how we measure it, and really how to navigate it at all. And then once we've got the basics down, we'll talk about how all of this is evolving. We'll do a quick crash course on the changes that have come out this year on the regulatory side, and then also what's coming next. And then we'll talk about how to tackle it, whether you're doing this as an organization for the first time or you're evolving your practice. So Neil, let's jump ahead to the next slide. And let's get down to the basics. Let's talk about what is ESG. So ESG is a framework, and it's been used by, investors, regulators, and businesses to really evaluate and measure the sustainability and the ethical impact of a company's operations and its practices. And it stands for environmental, social, and governance. This first pillar, environmental, really focuses on a company's sustainability risks and impacts. And it tends to include factors such as a company's carbon emissions, energy efficiency, waste management, water usage, and really overall environmental sustainability. This next piece, the social aspect of ESG, tends to deal with a company's impact on people, both internal and external to the business. So this can include employee treatment and well-being, diversity, equity, and inclusion, labor practices, community engagement, human rights, product safety, and more. And evaluating that social dimension really helps assess a company's commitment to responsible and ethical business practices. And then lastly, the governance piece. This refers to really the system of rules, practices, and processes by which a company is directed and controlled by. So this aspect of ESG examines the company's leadership structure, board composition, executive compensation, transparency, ethics, and compliance with laws and regulations. And good governance, of course, is seen as essential for preventing corporate misconduct and really making sure that a company is managed in the best interest of all its stakeholders. But for the purposes of today's presentation, we're going to be honing in on the E pillar, and it's really for two reasons. First, because the regulations tell us that really this is the most important one for us to prioritize. And then second, because you're all finance folks, and of these three pillars, this is the pillar that's going to require more of a focus on quantitative measures and controls. If there's any theme to today's presentation, it's this: Effective ESG reporting is all about treating sustainability, social, and governance information with the same rigor that we treat financial information. And I firmly believe that finance teams are not only really suited to tackle this problem, but I think it's only a matter of time before every finance team is going to be pulled into some version of an ESG project if you haven't already. All right, so let's jump ahead. Why is ESG something that investors are looking at? And really there's a couple of different reasons that organizations are focused on ESG, and they range from voluntary to mandatory. First things first, brand reputation is a big one. Consumers want to spend their dollars with businesses that they can feel good about. They're demanding more transparency. They're demanding more accountability. I read a stat from PwC that said something like 76% of consumers will stop buying from a company that treats the environment, employees, or the communities that they operate in poorly. And that is a huge chunk of consumers. So brand reputation remains something that is paramount in terms of why folks focus on ESG. From a mitigating risk perspective, ESG initiatives, they can really help organizations mitigate potential regulatory, financial, and reputational risks that are associated with climate change and environmental concerns. And as new regulations are created, organizations that have already implemented ESG initiatives are more likely to be in compliance and avoid penalties. And it not only saves organizations money, but again, it helps them maintain that positive reputation, both externally and with regulators. And then finally, of course, it comes back to the money. There's real ROI in prioritizing ESG initiatives. One of the main benefits that we've seen is better credit scores, improved access to capital. When organizations can demonstrate a strong commitment to ESG, they can attract more investment, they can improve their financial performance. I saw a report not too long ago from CDP that said companies that disclose their carbon emissions, that disclose their climate change strategies, they received an average of 1.2 billion more in investment from institutional investors compared to companies that did not disclose this information. So as time goes on, this is becoming more and more something that is expected. And less of something that companies are opting out of. So let's move ahead, because there is an elephant in the room in all of this, and that is that ESG is not a topic that doesn't come without some controversy, particularly here in the US. Some folks see it as a politicized issue. For the most part, we've got some folks that are pro ESG, believing that it is an important accountability measure to help slow climate change, to encourage equitable, responsible, and transparent business operations. And then, of course, the critics and the opponents of ESG, their concerns range from either, ESG reporting presents an undue burden on businesses because there's a lot to gather, to monitor, and to report. And up until this point, there haven't been clear or practical guidelines or really standardization to have any trust in the information that was being requested to be reported on. And then also ESG reports haven't actually accomplished what we wanted them to do. The argument is that, historically, sustainability reports have been more focused on the impact that climate change has on an organization than the organization has on the environment. And honestly, that's been true for the most part, but things are moving in the right direction, particularly with some recent developments on the regulatory side, which have focused on clear guidance, practical implementation, and double materiality. So let's go ahead and we'll talk a little bit more about double materiality.